Okay, welcome to the next chapter in Trading with Market and Volume Profile course. So this is going to be sort of an add-on or extension of chapter 4, and we're going to be talking about how market moves. So what I mean by that is we're going to just look at the relationship between volume and liquidity, just so we have a better understanding of how the markets move based on the different levels of activity that we have from the market participants, so from buyers and sellers. This is more closely related with order flow trading, and I actually have a chapter where I talk about this in my day trading with order flow and volume profile course, but I think it's valuable to talk about this in this course as well, just so we can have a better understanding when we're talking about balanced and imbalanced markets or trends, etc., just to have some more context to go along with it. So let's start off by defining volume. So the volume of trade refers to the total number of shares or contracts exchanged between buyers and sellers during a period of time. The volume of trade is a measure of the market's activity and liquidity during a set period of time. Higher trading volumes are considered more positive than lower trading volumes because they mean more liquidity and better order execution. Okay, so we're going to see this in the next slides, but when we have markets with high volumes, then we have more market participants and we are more likely to be able to get a favorable fill on our positions because we're going to have a lot more orders resting in the order books. And then liquidity refers to the efficiency or ease with which an asset or security can be converted into ready cash without affecting its market price. The most liquid asset of all is cash itself. So basically, think of liquidity as the amount of orders that a market has, okay? And even within the same market, the liquidity is going to change a lot based on the time of day, on economic or news events, etc., as we're going to discuss in a little bit. The more liquid an asset is, the easier and more efficient it is to turn it back into cash. Less liquid assets take more time and may have a higher cost. Okay, so right here we have a DOM, a depth of market. I just have it blanked out, and we're just going to use it to quickly go through some examples of the concept of volume and liquidity. This, again, I just took a screenshot. This is from the bond market, but this can be any market you want. So this is the price scale. The bid is going to be our resting limit orders to buy, which are all going to be below the current price. And the ask or the offer is going to be where we have the passive limit orders to sell, and they're all going to be on the right side on top of the current market price. So what this means is, in order for markets to move, we need to have both aggressive and passive participants. Passive participants have limit orders waiting for price to come and fill them in, and aggressive participants are just executing with market orders. So if price is right here and you're an aggressive trader that wants to get long, you're going to have to pay up and hit that limit order to sell in order to get filled. Because remember, for every buyer, there's a seller. For every seller, there's a buyer. Same thing here. If price is right here and you want to get short right away aggressively with a market order to sell, then you're going to be hitting the bid. So that means you're going to be paying down in order to get filled immediately to get short on the market. So you're going to be selling into a resting buying limit order. Okay. And the concept of liquidity then means if you take a market, for example, like the S&P or the NASDAQ that are highly liquid, that means you're going to have a lot of contracts, hundreds of contracts layered up at every tick level that you have, and hundreds of contracts, or well, dozens or hundreds depending on the time of day, layered on the offer looking to sell. Okay, so if you're right here and you're, a small retail trader, you can definitely get filled in at the very next tick, either to get long or to get short. Okay, what happens is, if you have markets that are not very liquid, like if you take some exotic forex pair or some unknown cryptocurrency, etc., markets like that, or you're trading during very low volume times of the day, for example, right after the New York close, so just in the early hours of the Asia session, for example, then you're not going to get a lot of liquidity. So what happens if price is right here, and let's say you're trading a very thin market that has just a few orders here, a few orders here, a few orders here, here, then what's going to happen is, if you want to get long, if you just go with a big market order to buy, you're probably going to clear up all these levels in the order book, and your average fill is going to be somewhere around here. So what happens is, this area right here is what's going to be called slippage, because you did not get filled at the next best price, but you got filled at an average price higher. So already you're immediately in the red, because you did not get a proper fill on your order. So in this case, instead of being long from this level, you're going to be long from up here. So you've already paid up this whole amount because there's not enough resting liquidity in the market. Okay? So this is a little template that I have where we're going to be looking at 4 different scenarios and how this is going to reflect in price movements in the market. So if you have a market with a high volume and low liquidity, you're going to see big impulsive moves, as just a few big orders can consume all the available liquidity. This is a very common thing to see right before major news events. And if I go here and I'm going to open TradingView, just to show you an example from today when I'm recording this video, this is the S&P 500 futures, the ES. Today we had a CPI announcement on inflation. And what can you see right here? This is a 1-minute chart, and look at this huge red candle with, actually, sorry, I have the colors backwards. Okay, right there. That looks better. Normally I have my charts on light mode, but I turned it into dark mode for this video. So I had to switch the candle colors. So right here, you can see that exactly at 8:30 a.m. Eastern time, as soon as the number was announced, we had a huge move down. And what can we see here? Look, pretty much from around 3:30 a.m. when Europe market opened until 8:30, we spent 3 hours with the market barely making any movements, just sort of dwindling down slowly, trading sideways. This right here is an example of a very low volume, or even a high volume, let's say, because it's the S&P 500, low liquidity environment. So nothing is happening here because there's no large market participants doing anything. But as soon as the news hits, it only takes a few large block trades in order to just push this market into a very impulsive move. Okay, so that is a typical example of what we would have on a market where we have high volumes that are coming in right at the news event as we had right here, and there's low liquidity in the books. Okay. And remember too, just going back to this thing, most of us are retail traders that are not putting on really huge orders. So for us, we never have to worry about, moving the market or really getting unfavorable fills if we're trading some well-known market. But when you have institutional traders like banks, central banks, hedge funds, etc., these are players that are putting in huge positions that are market movers. Okay, so what they have to do is what we talked about. They need to split their orders into what is called icebergs. If you heard the term iceberg orders basically means where you take a big order and you split it into several small orders. So you first not only don't catch, or don't call out attention by having a gigantic order resting here, even though sometimes you will see very large orders here, which may or may not be, intended to be filled, that's another whole other thing that's called spoofing, which is not actually permitted, which is when you just place false orders to give the impression that there's a lot of interest at a certain level. And once the market gets close to them, the orders are just canceled. That's called spoofing. But with the iceberg orders, what these market participants do is they're not going to just market buy right here, because they're most likely going to push this whole market up many points against them, and they're going to get an unfavorable average fill on their execution. So what they do is they'll just split the orders. So then they'll just have, they'll just put few limit orders here to buy. When the market comes down, it'll start filling part of it. Maybe it's going to push up a little bit on their buying, but then it's going to start coming down again. They're going to again layer more orders. And remember, a lot of this is all driven by algorithmic trading, where you're just going to have reloading and reloading whenever the market comes into this area. But that's a way that big institutional players are going to be loading up their orders, is by splitting them up into iceberg orders in order to not push the market against them. Okay. The next example is when you have a low volume and high liquidity. This happens a lot, for example, like I was saying during the Asia session in the markets, pretty much, right around the 6 p.m. hour when futures market open, for example, you're going to have, like in the S&P or the NASDAQ, a lot of resting orders on the book. Definitely not as high as you would have on regular trading hours, but it's still a considerable amount. But there's not a lot of market participants interested or coming in at that time, not a lot of large traders. So that's going to give us small price movements, because there's not really any large orders, pushing the market higher or lower significantly. The next one is going to be low volume, low liquidity. And similarly, you're going to see small levels of volatility can be seen on certain times of day and before big news events. Okay, so this environment is going to be what we would see, like I was saying, right here. Right before, for example, big news events, you're going to have low liquidity, low volume environments like this. Once the news hits, then this is when we're going to see the huge infusion of volumes, and then that is going to bring us into the first market condition that we have here, which is high volumes, which causes big volatility. And then eventually, once liquidity starts coming back into the book, once market makers and big traders start putting in orders again in the order book, then the market conditions are going to regulate. And then finally, the condition that we see, normally during regular market hours, so from like 9:30 a.m. to 4 p.m. in the Eastern time during stock market hours, like S&P or NASDAQ or gold or euro, US dollar, etc., is we're going to have moderate price movements because, we have high levels of liquidity resting on the book, and there's high participation because now the stock markets are open. So we're going to have, retail traders, hedge funds, banks, institutions, all trading around the same time, especially when we're talking about centralized markets like futures, where all the orders are going to be going into the same place. So when we have those trading environments, we're just going to see, that's when we have regular market behavior. Like here, if I go into the hourly chart, this is when we're going to have, for example, right here, just regular trending markets like this, where we have nice moderate trending movements, etc., because we just have big volumes but also high liquidity to be in, therefore giving us effective auction market theory. What we talked about, the market is facilitating good trade between buyers and sellers. Okay, so that's pretty much it for the video. This is just a little recap of relationships between volume and liquidity, and how that relates with how markets are going to be moving. See you all in the next section.